Well, the economic expansion is maturing. In the summer, the US will enter its 11th year of economic expansion. But I think talk of global downturn, recession, that's perhaps a little bit premature. So this week, for example, we've had data from China suggesting a pickup in business sentiment, both in the manufacturing and the services sector. And this is very important because we've had months of stimulus being implemented and announced by the Chinese authorities. And now we're seeing the first potential signs of this having some impact. And then in Europe, the German IFO business sentiment indicator also increased for the first time since last July. So there's evidence there that perhaps we're beginning to see some stability in the economic data. And I think that's very important for the general outlook going forward from here. So fears of a recession in the US comes partly from the inversion of the yield curve. But the 2-year, 10-year has yet to invert. And that suggests to me that the timing of the next US recession could be pushed beyond the presidential elections that take place in November 2020. So while the cycle is maturing, talk of imminent recession or even recession over the next 18 months appears a little bit premature at this point in time. Brexit certainly isn't helping. And of course, this week we've had this second round of indicative votes in Parliament that failed to give us a majority in terms of the direction of travel. However, there is some good news here. We are slowly moving towards a softer Brexit. The customs union motion failed by just 3 votes. And then the second referendum endorsement motion got the largest number of votes, 280 votes. So it's clear what's happening here. If we go into a third round of indicative votes, I think it's very likely we will get a majority in terms of moving towards potentially a customs union. So it's very clear what the choices are. It's Theresa May's deal, potentially, if it's brought back for a 4th time, or we're going to go to a longer extension, a rethink, and a move towards a softer Brexit. That's all positive. Now, there are some uncertainties in a longer extension, general election, a very divisive second referendum. So it's not all good news, but the big picture assumptions here that we are making, it's either Theresa May's deal, which removes the uncertainty, or a softer Brexit in a long extension. Well, the dollar performed well in the first quarter and advanced on a DXY basis. But the extent of the slowdown in Europe has been greater than what we had anticipated. So we've had to cut our euro-dollar forecasts. So previously we're expecting 120 by the end of 2019. We've reduced that now to 116. But we do still expect dollar depreciation. As I mentioned earlier, we are expecting Chinese growth to stabilize. If the global macro backdrop improves somewhat, that should open up some degree of dollar depreciation going forward. For the pound, obviously, it's a little bit trickier with the Brexit uncertainty as it unfolds over the next week or two. But again, assuming one of 2 big picture assumptions, Theresa May's deal gets through, or we go into an extension moving towards a softer Brexit, both of those scenarios are positive for the pound. So while we've cut our pound forecasts because the dollar is performing better, we still expect the pound to appreciate versus the dollar going forward.